October 24th, 1929. Wall Street lost $4 billion in 6 hours. By the following Tuesday, another $14 billion vanished. Within a week, $30 billion gone. That's 500 billions in today's money, erased in 7 days. This wasn't a natural disaster. This wasn't bad luck. This was a mathematical inevitability that everyone saw coming, and nobody stopped. The 1929 crash didn't just destroy wealth. It ended an era, triggered the Great Depression, and changed American capitalism forever. Here's what actually happened. Not the textbook version. The mechanical breakdown of how the greatest financial collapse in American history unfolded, who saw it coming, and the exact pattern that's repeated twice since then, in 2000 and 2008. If you understand 1929, you understand every market crash that's happened since. This is how Wall Street's golden age ended. To understand the crash, you need to understand what came before it. The 1920s weren't just prosperous, they were euphoric. World War I had ended. America emerged as a global power. Industrial production exploded. New technologies, radio, automobiles, electricity were transforming daily life. And Wall Street became the center of American ambition. Between 1924 and 1929, the stock market tripled in value. The Dow Jones went from 100 to 381. Everyone was investing, not just the wealthy, ordinary Americans. Barbers, taxi drivers, secretaries, they borrowed money to buy stocks because stocks only went up. Right? Here's the mechanism that created the bubble. Margin buying. You could purchase $1,000 worth of stock with just $100 down. The other $900 borrowed from your broker at 10 to 20% interest. If the stock went up 10%, you doubled your money. If it went up 50%, you made 5x your investment. Leverage multiplied gains. But leverage also multiplies losses. And in 1929, most stock purchases were 90% borrowed money. Investors weren't buying stocks with savings, they were buying with debt, betting that prices would keep rising forever. When you borrow $9 for every $1 you own, you need the market to keep going up. If it falls even 10%, you're wiped out. By September 1929, stock prices had detached from reality. Companies were valued at 30, 40, 50 times their earnings. Investors didn't care about fundamentals, profits, revenue, growth. They cared about price momentum. Stocks went up because people bought them. People bought them because they went up. Classic speculative mania. And then in early September, the market peaked. The Dow hit 381 on September 3rd. For the next 6 weeks, it drifted lower, slowly at first. A few points here, a few points there. Professional investors, the smart money, started quietly selling. They'd made their fortunes, they were getting out. But the public kept buying because stocks always recovered. Everyone said so. October 24th, 1929. Black Thursday. The selling began at 10 a.m. Within an hour, panic set in. Investors who bought on margin received calls from their brokers. Put up more cash or we're selling your shares. They couldn't. They didn't have cash. Everything was leveraged. Brokers started dumping shares to cover loans. This drove prices down further, which triggered more margin calls, which forced more selling. A death spiral. By noon, the exchange floor was chaos. Traders shouting, crying, collapsing. The ticker tape, which displayed stock prices, couldn't keep up. It ran 2.5 hours behind. Nobody knew what anything was actually worth. At 12:30 p.m., a group of bankers met at J.P. Morgan's office. They pooled $240 million to buy stocks and stop the panic. It worked temporarily. Prices stabilized. The market even recovered slightly by close. People breathed. Maybe it was over. It wasn't. Over the weekend, margin calls went out. Investors who'd been holding on borrowed time had to sell. On Monday, October 28th, the market dropped 13% in one day. $4 billion vanished. And then came Black Tuesday. October 29th, 1929, the worst day in stock market history. The market opened and immediately plunged. No buyers, just sellers. Everyone trying to get out at once. By closing bell, the Dow had dropped another 12%. 14 billion, gone. Here's what people don't understand about the crash. It wasn't one day. It was a cascade. Black Thursday started it. Black Tuesday accelerated it. But the real destruction happened over the next 3 years. The Dow kept falling. 381 in September 1929, down to 41 by July 1932, an 89% loss. Fortunes built over a decade erased. The 1929 crash didn't just destroy stock portfolios, it destroyed the economy. Here's the mechanism. When the market collapsed, banks failed. Why? Because banks had loaned money for stock purchases. When stocks became worthless, borrowers couldn't repay. Banks lost billions. Over 9,000 banks failed between 1930 and 1933. When banks failed, depositors lost their savings. There was no FDIC, no deposit insurance. If your bank collapsed, your money was gone. With savings wiped out and banks failing, consumer spending collapsed. People stopped buying cars, radios, appliances, factories laid off workers. Unemployment hit 25%. 1 in 4 Americans couldn't find work. With no income, people couldn't pay rent or buy food. Breadlines formed. Shanty towns called Hoovervilles sprang up in every major city. The economic contraction was unprecedented. GDP fell 30%. Industrial production dropped 50%. International trade collapsed by 2/3. This wasn't just a market crash. This was a systemic failure of the entire economy. And it lasted a decade. What made it worse was government response, or lack thereof. President Hoover believed markets would self-correct. He opposed government intervention. By the time Franklin Roosevelt took office in 1933, the damage was catastrophic. It took the New Deal, massive government spending, banking reform, social programs, and eventually World War II to pull America out. Here's what's fascinating about 1929. Some people saw it coming. They warned about overvaluation, excessive leverage, speculative mania. They were ignored. Economist Roger Babson predicted the crash in September 1929. He was ridiculed. Yale economist Irving Fisher said stock prices have reached what looks like a permanently high plateau just days before the crash. He lost his entire fortune. But a few investors understood what was happening and positioned accordingly. Joseph Kennedy, JFK's father, sold all his stocks in early 1929. He later said he knew it was over when his shoeshine boys started giving him stock tips. When everyone's in the market, there's nobody left to buy. Bernard Baruch, a financier and presidential advisor, also sold before the crash. He'd made millions in the 1920s bull market, but he recognized the signs: margin debt at all-time highs, valuations disconnected from earnings, euphoria replacing analysis. He got out with his wealth intact. Jesse Livermore, one of history's greatest traders, went short, betting against the market. He made $100 million during the crash, worth over $1.5 billion today. He understood crowd psychology. When everyone believes stocks only go up, the end is near. The pattern is always the same. Easy credit fuels speculation. Prices rise beyond fundamentals. Leverage amplifies gains until it amplifies losses. Margin calls force selling. Selling creates panic. Panic creates collapse. It happened in 1929. It happened in the dot-com crash of 2000. It happened in 2008. So what does 1929 teach us? First, leverage is a double-edged sword. Borrowing to invest multiplies returns when markets rise, but when markets fall, it destroys you. The investors who survived 1929 were those who used little to no leverage. Second, valuation matters. When stock prices rise far beyond what companies actually earn, a correction is inevitable. It might take months or years, but math always wins. If a company earns $1 per share and trades at 50, something has to give. Third, when everyone's investing, when taxi drivers and shoeshine boys are giving stock tips, the end is near. Markets need new buyers to keep rising. When everyone's already in, there's nobody left to push prices higher. Fourth, government intervention matters. The 1929 crash became the Great Depression partly because the government did nothing. In 2008, the government stepped in immediately. Bailouts, stimulus, zero interest rates. You can debate whether that was right, but it prevented a second Great Depression. The 1929 crash destroyed $30 billion in a week, but the real damage took years. Banks failed, savings vanished, unemployment hit 25%. An entire generation lost faith in markets, in capitalism, in the American dream. It took World War II and 15 years to fully recover. October 1929, the day Wall Street's golden age ended. Not because of bad luck, because of mathematics. Because leverage, speculation, and euphoria always end the same way. The pattern hasn't changed. It happened in 1929. It happened in 2000. It happened in 2008. And it will happen again. The 1929 crash shows us one truth. Markets don't crash because of single events. They crash because of structural fragility built over years. Easy credit, excessive leverage, speculative mania. When those conditions exist, a crash isn't a question of if, it's a question of when. Subscribe to Wealth Archives for more breakdowns of how markets work, how fortunes are made, and how empires fall. Comment below. What's one warning sign you see in today's market? New episodes posted regularly. See you in the next one.